Inflation. It's a word that strikes fear into the hearts of investors and consumers alike. But what exactly is it, and why should we care? In simple terms, inflation is the rate at which prices for goods and services rise over time. This means that the purchasing power of your money decreases. What you could buy for $1 yesterday might cost you more today. This erosion of purchasing power is why inflation is often called a silent thief. It stealthily eats away at your savings and investments, leaving you with less than you started with in real terms. For investors, understanding inflation is crucial. It's not enough to simply chase high returns. You need to consider the impact of inflation on those returns. A seemingly impressive investment return might actually be losing ground against the rising tide of inflation. This is why it's essential to factor inflation into your investment decisions and strategies. Imagine you have $100 today. You could use it to buy a nice dinner, a new pair of shoes, or maybe even a small appliance. Now, fast forward 10 years. If inflation averages 3% per year over that decade, your $100 will have lost approximately 30% of its purchasing power. This means that in 10 years, you'll need $130 to buy what you could have bought for $100 today. This erosion of purchasing power is the insidious nature of inflation. It doesn't just impact your spending, it affects your investments as well. If your investments aren't growing at a rate that outpaces inflation, you're essentially losing money in real terms. This is why it's paramount to seek investments that offer a real return, meaning a return that exceeds the rate of inflation. When it comes to inflation, not all investments are created equal. Some asset classes are more vulnerable to its erosive effects than others. Fixed income securities, such as bonds, are a prime example. Bonds typically pay a fixed interest rate, the coupon rate, over a predetermined period. While this predictable income stream might seem appealing, it becomes problematic during inflationary periods. As inflation rises, the purchasing power of those fixed interest payments diminishes. Let's say you own a bond paying a 4% coupon rate. If inflation is running at 5%, your real return is -1%. This means your investment is losing ground against inflation. In essence, your money is losing value even though you are receiving interest payments. This is why investors need to be especially cautious about holding large amounts of fixed income securities during periods of high or rising inflation. So, if fixed income investments are vulnerable to inflation, where should investors turn? Equities or stocks are often touted as a good hedge against inflation. This is because companies have the ability to raise prices for their goods and services in response to inflation, potentially protecting their profits and in turn, the value of their stock. However, it's crucial to remember that not all stocks are created equal when it comes to inflation protection. Companies operating in certain sectors, such as consumer staples or utilities, might find it more challenging to pass on price increases to consumers without impacting demand. On the other hand, companies in sectors like energy or materials might have more pricing power during inflationary periods. The key takeaway here is that while equities can offer a degree of inflation protection, it's not a guarantee. Investors need to be selective about the stocks they choose and focus on companies with strong pricing power, a solid track record of profitability, and a history of navigating inflationary environments successfully. Section 5. Real estate and commodities, tangible assets in uncertain times. Besides equities, other asset classes can provide a measure of protection against inflation. Real estate, for instance, is often considered a good inflation hedge. This is because as the general price level rises, so too does the value of land and buildings. Additionally, landlords can often adjust rents to keep pace with inflation, providing a natural hedge against rising costs. Commodities, which are raw materials like oil, gold, and agricultural products, can also act as an inflation hedge. As the cost of goods and services rises, so too does the demand for, and consequently, the price of the raw materials used to produce them. It's important to note that investing in real estate and commodities comes with its own set of risks and considerations. Real estate can be illiquid, meaning it can be difficult to sell quickly if needed. Commodities, on the other hand, can be highly volatile, with prices fluctuating significantly in short periods. Section 6. Diversification, the cornerstone of inflation protection. So far we've discussed various asset classes and their potential to hedge against inflation. However, the most critical concept to grasp when it comes to inflation protection is diversification. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, sectors, and geographies. A well-diversified portfolio can help mitigate the impact of inflation by ensuring that no single asset class or investment holds an excessive amount of your capital. If one asset class underperforms due to inflation, other asset classes might perform better, helping to cushion the blow. Section 7. Navigating the unpredictable seas of inflation. Predicting inflation is a notoriously difficult task. Even the most seasoned economists and financial experts often get it wrong. Inflation can be influenced by a myriad of factors, including government policies, global supply chain disruptions, geopolitical events, and changes in consumer behavior. This inherent unpredictability makes it challenging to develop an investment strategy based solely on inflation forecasts. Instead of trying to predict the unpredictable, focus on what you can control: your investment strategy. Build a diversified portfolio that aligns with your risk tolerance, time horizon, and financial goals. Consider incorporating assets that have historically performed well during inflationary periods, but don't neglect the importance of equities and other growth-oriented investments. Section 8. Conclusion. Prudence over prediction. Inflation is a constant threat to investors, eroding the purchasing power of savings and diminishing the real return on investments. While it's impossible to completely eliminate inflation risk, investors can take steps to mitigate its impact. Diversification, as always, is key. Don't rely solely on any one asset class or investment strategy. Remember, successful investing isn't about predicting the future, it's about managing risk. By understanding the impact of inflation and building a resilient portfolio, you can navigate the challenges of an ever-changing economic landscape and work towards achieving your long-term financial goals. Thank you for listening.